Good evening and a warm welcome to everybody. I'm Angelica Kinney, your host for the webinar today, and let's dive straight into it. Today's webinar is all about mastering smart beta, momentum, alpha, and low volatility funds. And to understand this better, it is my pleasure to introduce Mr. Hemang Udeshi. Mr. Hemang Udeshi is the national lead of ETF Products at Nippon India Mutual Fund. Sir brings over 13 years of financial services expertise to the table and is a key member of the passive products team. He drives product development and management with a decade of experience in the index industry. Sir has a proven track record of developing successful indices for ETFs, index funds, and structured products. Sir brings both expertise and practical insights to the table today with a wealth of knowledge. Before moving ahead with the session, please know that if you have any questions, please send them up in the comment box and we would address those towards the end of the session. Sir, over to you.
Thank you so much, Angelica, and thanks for the very generous introduction. Hello, everyone. Today's topic is basically about passives, and to be very specific, on smart beta funds, right? So, I would like to have my presentation in two sessions. I'll break it up in two sessions. We'll talk about passive investing in general for those viewers who do not know what that is. And then we'll dwell into the main topic of the day, that is smart beta products. So to start with, so what do you understand by passive funds? So passive funds generally are normal open-ended mutual funds that replicate an index or track a performance of a benchmark. So we all know Nifty 50, Sensex as most popular indices. To name a few, there's bank, IT. So passive funds basically replicate the composition of underlying index to mimic its performance, right? Now, these passive funds have certain types. So most of the times you might have heard of ETF, right? So ETF or exchange traded fund, as they are called, are passive funds specifically, that are available to trade on the exchange during the market hours. So one can easily buy or sell a stock during the market hours at the desired price, right? Index funds are also passive funds that replicate an index, but to purchase or sell, they are available at end of day NAV that is published by a particular AMC. Okay. For FOF, a fund of funds, in context of passive itself, right, they generally invest into an underlying ETF unit. So, just to give you an example, um, there is a gold ETF that is trading on an exchange. An investor who might not be able to have a demat account to purchase those securities can invest into a FOF, which is like a gold FOF or a silver FOF. There are certain equity related FOFs also plentiful available in the market. Um, this will help those investors that do not have access to a broking account, right? So there it comes into picture, but all these three types of funds come under the bouquet of passive funds. Yeah. So now we get into how different passive investing in is from active investing. They are both two separate different ideologies of one single spectrum, right? Both different ends of the spectrum. So generally, we all are more aware about active investing. We are aware about most of the funds that are available in market. So thereby, in those active funds, a fund manager tries to outperform the underlying benchmark. So basically, if say for example, one is looking at Nifty 50, a fund manager who's managing a large cap scheme would seek to outperform the Nifty 50 itself, right? Whereas in a passive fund, the ETF or index fund would try to replicate the performance of the underlying index and not outperform it, right? The management styles also, like I said, are different. So in case of an active fund, the fund manager, based on his judgment and expertise, would want to pick up stocks or sectors as he feels right during a particular time, and based on his judgment would want to invest in those stocks that would form part of his fund. In case of a passive fund per se, like I said, it would mimic the composition of the benchmark itself, right? There will be no stock picking per se, right? So let's say, again, taking example of Nifty 50, there are 50 constituents as the name suggests, right? And each constituent will have a particular weight in the index. Now, the passive fund manager's duty is to exactly replicate weight of all those 50 stocks in his fund. So there is no stock picking, there is no judgment involved. It is completely rule based, and he would, in fact, try to do this as and when composition of index changes. Between the periods of when there is any change in index, there will be no action taken. The index fund would move according to the movement of the market, subject to expenses. Third point comes as turnover. So, in case of an active fund at different points in time, based on the market situation, the fund manager might take a call, an active call, to sell or buy certain securities as deemed fit, right? So the turnover tends to be a bit higher. In case of passive funds, as the index composition would only change when the index, underlying index, which is published by the exchange, has a composition change, only then the fund manager will change the composition exactly mimicking the newer composition, right? So this, in a way, also leads to the change of expense in both types of strategies. In an active fund, as the call is taken at a higher frequency, there is a higher turnover. Hence, there is a added cost to it, right? And because it is based on such a research of the fund manager and the analyst, there's also that cost involved, which is also known as a research cost. So generally, the expense ratio tends to be higher. While at the same time, in passive funds, as it is replicating, emulating the performance of the underlying index, and no research cost is involved. Also, the turnover tends to be lower because it only changes at time of change in index, which mostly is semi-annual or the quarterly basis. The cost tends to be lower. So you, as an advantage, by taking a passive fund in picture, get to take exposure to an entire market through just a single unit. So 50 stock Nifty 50 can be bought by you by purchasing a ETF or an index fund which is based on Nifty 50, for example's sake, right? So we want to understand that what is currently the landscape of passive funds globally and in India, right? So these funds have been there since more than 2 decades globally, right? And you can see the growth, which has been very prominent, in fact, from near periods. Globally, because the markets are more matured, the growth has been more, started off a decade back, whereas in India per se, this has been a recent phenomenon. So you can very well see in the graph shown here, $3.4 trillion market back in December 16 has now touched 14.7 trillion in December 24. Talking about India, as I said earlier, so passive funds divided into ETF and index fund predominantly. So almost 75% of the 11 lakh passive fund AUM across the Indian industry, that is 8.1 lakh crore, is in ETFs, while remaining is in index funds. Even in asset classes, if you see, is predominantly dominated by equity, then by debt and commodity. There too, the ratio might be around 70-20. Correct. Now let's see how has these funds grown over a period of time. So here we are trying to compare and show how slowly but steadily passive funds have started gaining traction, especially since post-COVID era. This may be attributed to more awareness, digitization, or overall perspective of market changing, right? So earlier the market share in the whole AUM industry of passive funds was around 3.8% in, you can see, in March 2018, which has gone up to 16% in a very short period of time, right? In fact, if I go a decade back, it was 1.5% in March 14, which has gone to 16% in Jan 25. Now, specifically speaking about ETF, as you can see, the growth has been tremendous. The chart itself is a 45-degree angle, and an INR 1 billion in March 2004 has touched 8,100 billion in Jan 2025. Similar case with index funds. You can see the steep rise that is there since 2020. A 5 billion in 2004 has touched 2.8 thousand, 2,800 billion in 2025. Now, what are the reasons for these funds to be popular, right? The first and foremost reason is transparency. When I say transparency, like I said earlier, the fund would emulate to mimic the performance of the underlying index. So it will invest in those stocks which are available in index, right? Index, like you all know, majorly, if you say a benchmark bellwether index like a Nifty or a Sensex is tracked by most, is available to see throughout the day, right? The compositions are available; they're publicly available, in the domain. So one can always see what the portfolio consists of. The index fund itself would emulate to have same stocks in same weightage proportion as the index. Point number two is within the transparency. So whenever an index is made, right, it is created. So they have certain rules and criteria which is decided by the exchange. Now they will have certain criteria such as, that it will be rebalanced only at a particular periodicity, like a semi-annual, quarterly, monthly. You know, they will have filtration criteria of what can come in, go out, how liquid the stock should be. All those detailed results are back tested since day one. Like for example, of a decade of 2 decades or 3 decades, like Nifty 50 has been in inception since 1996. Sensex is much older than that, and those methodologies do not change very frequently. They are there in the public domain available, and they are very transparent, rule-based method. There's no tinkering, so it's very transparent that way. Second is that by, like I said earlier, by buying a single unit, you get a diversification to the whole market. You're purchasing the whole market by purchasing a single unit. So people who might be wanting to take, say for example, a call that today I feel bank or an IT, or a consumption, few stocks look good, and you would want to go and purchase a few stocks, right? Instead, and you're not sure, right, which stock might work for you, which might not work for you. You are always, churning yourself on that. This product makes best sense to directly purchase the entire basket of stocks. So like I said, bank and IT, you can just pick up a fund which is replicating a bank index per se. You can just pick up a fund which is replicating an IT index per se. You get an exposure to 10 to 15, 20 stocks in one go, and you do not have to worry about which stock might work for you and not work for you, because these portfolio of indices are based on market capitalization. So a highest market cap or larger stock would get higher weight. Per se, you are taking up the whole bucket, right? Immense diversification benefits. Third point comes to non-systematic risk. Now, what does that mean? So, like I said earlier, active fund manager or the stock picker or the trader might choose on his own understanding of market certain stocks and take a call that this may or may not work. Right? They might go overweight on certain sectors, might go underweight on certain sectors. It is finally a call, right? So there is also a risk involved that that call might go wrong, or you may not gain the benefits that you were supposed to think that you might, right? So those all comes across as non-systematic risk, which can be completely avoided by just purchasing a single unit, which gives exposure to all the stocks in the bucket, right? And also, like I said, you get an exposure, good amount of exposure to the market at a very low cost, correct? Here in passive funds, specifically about FOF and index funds, non-demat account holders get a chance to take an exposure to the market. You have different plans available for FOFs and index funds in terms of direct and regular plan, right? Um, lastly, benefit of market wisdom. What does that say? So there are, when one can imagine, there are so many brokers available in India. There are so many mutual funds, number of analysts, number of people who are actively trading, PMS, AIF, portfolio managers, individuals. There are so many people who are on their own, trying to trade, trying to take a call on the market, right? Um, so what happens is you are thinking that you might outsmart them, but by study, which I'll come to at a later point in time and explain what, it says that it is very difficult to beat the market per se, and that too consistently over a period of time. So when I say benefits of market wisdom, when there are so many people who are trying to gauge on particular stock, right? They would, in a way, purchasing a stock, right? So it would be taking up the, everyone concentrating to purchase a single stock. That stock price will start going up, right? In theoretical sense of the word. Uh, when that happens, in the index itself, if the weightage is high and is a large cap stock, the index also starts moving according to that direction. If, say, for example, banking stocks become bullish because of certain news or reasons and some favorable information about banks, and they start working up. If you're buying, most of the people will start buying banking stocks. An index itself, because it has all those banking stocks within that bucket, right? It will also start moving with the market. So you get that benefit of wisdom of the market. And like I said earlier, these are low cost, low expense ratios. You don't instead, have to buy multiple stocks. If you are taking multiple stocks in your basket, you will have a certain limits with yourself. Like a small investor wanting to do a call on, say, even you know two stocks from a sector, or three stocks from a sector might exhaust 10,000 rupees. But the same person wanting to invest in a sector fund or the Nifty 50 bank or an IT fund, or something else, right? Would be able to purchase multiple units and take a good amount of chunk, of units, by spending the same amount of money and getting exposure to 50, 20, 30 stocks, based on what index you choose. So these are the main drivers, transparency, diversification, which makes them very attractive. Mostly people say that in case for a normal, very busy person, whose main job is not to be a broker or be in trading market, should ideally start moving towards passive funds, because that gives you space of mind to think about something else, or focus on your work or your own life, right? So that was more anecdotal, but I'll come to the study which has been published by a prominent, a prominent institution, and we'll talk more about this there. So moving on to the next slide. So this is what I was talking about, SPIVA, India Scoreboard. So what is SPIVA? SPIVA is published by Standard and Poor's. It is Standard and Poor's index versus active funds. So there are two tables that you can see on your screen. One is back way in December 2009, and the other is the recent one in June 2024. What it's trying to say is, I'll give you by an example. If you see, the first category listed is large caps, right? And the benchmark used to against it is the CNX Nifty. And what is it saying? It's saying the percentage of funds outperformed by the benchmark, right? So in a 1 year period, so it is saying 64%, right, of funds, large cap funds, were outperformed by Nifty 50. Once you expand that horizon to a 3 year period or 5 year period, back way in 2009, that percentage goes up. So if I take a 5 year horizon, 70% of large cap funds underperform the index, or other way around, the index outperform the funds, the benchmark outperformed the funds. So similarly in 2024, these numbers have gone pretty high. Now if you compare again the first line item of large cap, you see that in 1 year period, 73% of funds, that is active funds, large cap funds, underperformed the index, that is S&P India large mid cap index. Similarly, for a 3 year period, it becomes 72%, 5 year it becomes 86%. The percentage keeps increasing, right? Um, the point to note here is that in case if you are a person who's taking, active large cap fund, most of you might have seen that there's a rating or ranking given to the fund, right? The general market knowledge these days say that it is very difficult to beat the market, that too consistently. So when I'm talking about ratings, what I'm trying to say is, say example, you take a 5-star rated fund today, correct? The next year the performance may or may not be at a 5-star level. It might not be the top performing large cap. Third or second year it might go somewhere else. some other fund might have taken over that spot, and this keeps on happening, correct? So let's say you are a long term investor and you want to place your bet for next 5 years, 10 years. So what would you end up doing? You will end up owning too many large caps in your portfolio, or you will keep purchasing them and selling them at different points in time, right? Why not take an index fund and be rest assured that if you are a long term investor, at least as per the report, what it says is, let's say example of 5 year, 86% of times you have beaten other large cap funds in the market. So this is a very strong data point to keep in mind when you are looking to invest in such funds. Similarly, if you go down the line in the same table, if you see mid and small cap, the percentages are lower, yes, but they are keep on increasing as the years go by, right? So, just to highlight, so Nippon India Mutual Fund has a huge bouquet of offering in ETF and index funds both. So we offer almost 24 ETFs and 24 index fund FOFs, right? Spread across fixed income, equity, and commodity. To be very specific, to highlight a few, equity, the benchmark bellwether, Nifty 50 or Sensex, we have an ETF on it. The mid cap section has an ETF on it, right? Commodities like gold and silver has ETFs. If one is tending to go towards fixed income, one can look at a liquid fund, or one can look into 8 to 13 GSEC, which underlyingly invest into government securities. Correct. If one wants to invest in particular sectors, we have ETFs on bank, PSU, bank, IT, auto, pharma, so on and so forth. There are schemes, and specifically talking about strategy funds, we have Nifty 50 Value 20 as one of the strategy. I'll talk more about it later. Dividend Opportunities Fund, right? So we have exposure to an international China market. If one wants to take an exposure, there's Hang Seng piece. Similarly, in an index fund, right, portfolio, we have almost 13 equity index funds, 9 fixed income, and 2 commodities, right? So one can take exposure to any of the asset classes that they desire, right? Specifically, when I'm going to talk about strategy indices, we have almost 4 strategies funds that as an offering to the customers, and one can look at it. We'll talk more about it in detail. um, but I wanted to highlight that the ETFs that Nippon has are one of the market leaders. We have almost 55% of market share in the industry in terms of volumes. So why I'm specifying this is because ETFs, like any other stock, are traded on an exchange, like I said earlier. So while trading on an exchange, volume becomes important. One has to look at ETFs which have higher volume, because that will help you to buy in and sell in or transact easily at your desired price, right? So now towards the second section, let's talk about smart beta. So this is the main section we wanted to focus about. So smart beta is popular term these days used, is also known as factor funds or factor indices. Sorry, it is also known as strategy funds, right? So there are multiple names, but it means the same. Okay. So while talking about smart beta, if I take that word, let's hear what is beta first. Okay. When generally people talk about beta, so beta is basically nothing but market. So when one commonly refers to market, what is one saying? When we say the market is going up or market is going down, we are basically referring to a Nifty 50 or a Sensex, right? You are trying to look that and gauge how the overall market might be working. So Nifty 50 or 50 stock index captures almost 60% of the entire market, right? Similarly, Sensex does too, right? So it broadly gives you an idea of direction in which the market is moving. That is beta. So a fund or an ETF or an index fund trying to replicate the market is a beta fund. Now, vis-a-vis a beta comes the alpha. Now, we associate alpha with what? Active investing. Alpha is morely towards actively managed funds, because there, like I said earlier, the fund managers tries to outperform or gain the alpha, right? By beating the benchmark. That is the idea. That is the aim, right? So that is the alpha. So what is smart beta do? Smart beta is designed to be smart while being a combination of both active and passive styles of investing. How? So, like I earlier said, passive investing is rule based, it's transparent. So it takes those nuances from the passive fund investing, while like an active fund manager who picks up stocks wisely and who wants to take a call on the market based on his thoughts, the smart beta also actively chooses a factor on which one wants to take an exposure, right? So that is an active choice. There are various types of smart beta factor funds that are available in industry today. We'll talk about it more in detail. So those factors, one has to choose what one wants to do based on the risk profile, right? And one is actively making a choice to choose those factors. Why? Those factors will have a complete rule-based methodology in which they work, right? So they will try to, what these smart beta funds is trying to do is it will try to outperform its parent benchmark. Just to quote an example, let's say there is a broad index like Nifty 50, and you pick up a factor like a value factor, right? Value in general terms, one knows that one would want to pick up value stocks when they see that these stocks are undervalued. And I say undervalued, whose price to earning or price to book ratio is lower. Basically, one is looking at the fundamental values of a stock and thinking that the price of it does not do justice to the fundamentals. Fundamentals are great. The price is cheaper. Why not pick those stocks? So basically, what you're doing is doing value investing, right? So we have taken that, adopted that word, and said value as a factor. Now, I want to apply those value factors on uh, Nifty 50. So I put up, all the 50 stocks within that basket of large cap Nifty 50, the benchmark index. You take value factor, you add to it, and you say, I want 20 best value stocks from this bucket, right? So those become my index. That becomes a popular index, that is Nifty 50 Value 20 index, right? So it basically tries to outperform the Nifty 50 while being within the Nifty 50 bucket, right? But tries to be smart by picking up value. Similarly, if one says quality and one says I want to expand my universe, right? I want to take Nifty 200 or Nifty 500 as my bucket. When I say Nifty 200, it basically is Nifty 100, which is large cap, plus Nifty mid cap 100. So 100 large cap, 100 mid cap, right? It is combined, making Nifty 200. Now, from that, I'm saying I want, let's say, 50 stocks, which are quality stocks. My parent still being 100 plus 100. I'm taking 50 stocks based on quality parameters. What are quality parameters? It's nothing but like just taken thing like um, you are looking at company fundamentals, right? You are saying that certain companies which have good PAT numbers, which have good profit after tax, which has good earnings growth, which has taken lower debt, this is what you think in your mind, that becomes quality. So those factors you put in the basket and then name it as quality. Now, from the 200 basket, you apply these filters, right? You take stocks which have a higher P, higher EPS, earning per share, good PAT growth, good earnings growth, lower debt. You mix them up. You take top 50 stocks which give you these, which best emulate these factors, and by taking those up, you make an index out of it, right? And you rebalance it every particular period after a particular periodicity. That becomes your quality. So again, it is trying to outperform its benchmark index, right? So one more feature to add to these smart beta funds is that these are not market cap weighted. So let me take you a bit back again in passive funds. So in normal passive funds, and the first circle that I'm talking about is that they are mainly market cap weighted. So Nifty 50, Nifty 500, Sensex, BSE Sensex, BSE Tech, IT, Auto. So these funds, what they do is when they pick up stocks, and the largest stock which has the highest market capitalization will get the highest weight. So um, what would end up happening is few stocks in the index will dominate the index performance as a whole. So higher the market cap, higher the weight of the stock in the index. right? In smart beta, what it tries to do is that it tries to go away from this theory. Okay, it tries to say that because I am taking factor of value or quality, I am thinking that I want stocks aggressively which are very good in value or very good in quality, right? Or maybe very good in momentum, okay, which have taken a great run up. I want to give highest weight to those stocks. So these are factor weighted. So best value stock will get the highest weight. Best quality stock will get the highest weight instead of it being dominated by market cap. So generally these are non-market cap based. Sometimes there's a mix of it. They can be market cap and factor based together, a weighted average, right? Uh, so that is how it is. And just to come up, what are the different factors? We'll talk in the next slide. Here are those. So as you can see, there are almost 7 different factors in smart beta, right? Let's start describing one of them each. What you see here with an example, alpha. So what is alpha? Like we discussed earlier, alpha tries to beat the benchmark. So this factor also does the same. It picks up the stock which has outperformed the benchmark, that is Nifty 50, over a particular period of time, maybe a 1 year period. Sorry, right? So excess returns over market returns. Market being Nifty 50. Those stocks which have beaten Nifty over a period of 1 year period will be selected from a particular universe, right? Here the universe maybe for Nifty Alpha 50 will be top 300 stocks, right? From that they will pick up 50 stocks. That becomes Alpha. A low volatility, as the name suggests, it picks up stocks which have lower volatility or in technical terms standard deviation in the price of the stock for a particular period. So these low volatility funds, people who do not want to take aggressive risk. Again, when I say this, equity per se is risk, right? Equity investment is a risky investment. Within that, one would think that I don't want stocks which are very volatile, which have high ups and high lows. Um, I would want to pick up stocks with a lower, smoother volatility. So they would want to go with these funds, right? Lower volatility funds. Momentum. Momentum has become gained popularity in last few recent years, a big time, because we had seen a very good bull run post COVID, and these momentum funds have picked up in a very good way. So what does momentum fund basically do? Momentum may be science or by general common term, it is just movement, right? Momentum is when you toss a ball, you roll a ball and it keeps moving. It is momentum, right? So by that terminology per se, it is basically trying to capture the stocks which have already gained an upward trend or upward trajectory, right? Stocks which have performed well. That is the thesis of this, that stocks which have performed well in the past will keep performing better in the future. Um, let's say an example of cricket. Okay, you have seen a person playing well during his practice sessions in your own team. Let's talk about that. You have a own team of cricket, or few players are playing very well, and you bet on them that this will be the openers of a game. These might play well, right? You have seen a test of people playing any sport, and you feel that these people in the team are doing great. You're giving them a higher chance. So there is momentum per se. So here you're giving a better. You are assuming that the stocks which have done better in the past keep on doing better in the future. To back this hypothesis, what they do is this index. They will pick up stocks which have performed well in past 6 months period and 12 months period, both. They will give a weighted average to both. So stock which has only run up in the 6 months but has done poorly in the overall period and just done near term well performance may not get a best score. Similarly, something which has done very well in point to point, 1 year returns and near term it has not performed well, may not get a best score. It will be there somewhere in middle. They will try to check stocks which have given uptrend in both 6 and 12 month price movement, right? So that is a momentum. Value, like I spoke in depth. So value is basically picking up undervalued stocks. Parameters can be something like lower PV, lower PE, higher return on capital employed, high dividend yields, again in certain proportions, right? These are value stocks. In terms of equal weight, what is that? So let's say you have Nifty 500. Okay, a very good example. Now, Nifty 500 per se, when I'm taking passive, when I'm taking a call that I want to buy Nifty 500, there is one thing that I would want to say is you are basically still targeting large cap exposure to the most. Nifty 500 has an exposure of 65% towards large cap. Okay, another 20-25%, let's say, to mid cap, and another 10-15%, to small caps. So basically, when you are taking 500 stocks in the entire market, you are basically taking up large cap stocks. Now, what does equal weight do? Now, juxtaposition it and think in your mind that you are giving equal weight, same weight to each stock in the index of 500. So basically, your per stock weight, if I say 500 stocks is 100, divide it, you will get per stock weight of 0.02, right? 0.2% weight, sorry, correct? So all stocks in the index will get equal weight, 0.2% per stock. So what would that do? The concentration risk which is there in top few stocks, which is actually making it a large cap dominated, dissolves. All your stocks in 500 will get equal weight. Now, just a point to remember, when we talk about 500, right, the top 100 is large cap, the next 150 stocks is mid cap, and the last bottom 250 stocks is small cap. So in a way, what will happen is 100 large cap, right, will get 20% weight because 0.2. 150 mid cap will get 30% weight, right? And the last layer of small cap, because there are 250 stocks, end up getting 50% weight. So it exactly is inverse. If you take a triangle and you inverse it, it is exactly that from a Nifty 500. Nifty 500 being large cap dominated, mid cap and middle and small cap. This is becoming the weightage of segment exposure becomes small cap gets 50% weight, mid cap becomes 30%, large cap becomes 20%. So one has to remember this while taking exposure to such equal weight. Though it will give you a huge diversification benefit, one has to always be cautious that you are ideally taking 80% exposure to small and mid cap, right? So maybe it suits those who are okay to take higher risk, who are okay to wait for a longer period of time, right? A longer horizon. Again, longer horizon is subject to one its own. One can say a 3 year, one can say a 5 year. For me, it can be a lifetime, right? And one who may want to take an exposure to small and mid cap stocks, this becomes a very good proposition to go to, right? Dividend yield. Now, people who are wanting to only look at stocks which are having great dividend, generally these companies would be PSU companies, right? In general, which give good dividend during the period of their, per year. So those kind of stocks with higher dividend yield will get included in this type of a factor index. So stocks with higher dividend yield get higher weight. Quality, like I explained, a sound balance sheet to a company makes more sense. Higher profitability, lower leverage, lower, good stability, higher PAT, year-on-year earnings are great. So those stocks get formed in part of the quality bucket, and highest weight will be given to those which have highest quality. So this is just a brief, outline of what are types of factors that are available, what one can choose from, how what one works upon. We'll dwell more in detail, right? So, so what are the benefits, right? So smart beta investing. One would say, we already have got so many mutual funds. Why smart beta? So one thing, like I said earlier, these are passive funds. There's no active call in it. There's no one who's tinkering, no one who's thinking that today I want to do this because of this market scenario. No one wants to play with it. It is completely rule based. It gets rebalanced on a particular set date of periodicity, maybe quarterly or semi-annually, right? In between, the stocks would not move in and out of the index. These stocks, these strategies are brutal in terms of. Let me give you an example. For example, let's say for a active fund, generally when we say large cap, I cannot quote, but broadly, one would want to stay in and around a benchmark index. What I mean is, when Nifty 50 has certain weightages on particular stocks, fund manager would be either overweight or underweight to those similar securities. Let's say Nifty 50 has financial services 36% weight, one would be either overweight or underweight, but not completely out of it. In smart beta, what can happen is, like, it's because it is taking a call, because it is not because it is taking targeted exposure to a particular factor, it might be possible that that factor may not have any exposure to a particular sector. Okay. um, a few years back, for example, value did not have any exposure whatsoever to financial services sector, right? While that is not very easily possible for an active fund manager, and there will be some exposure to it. Generally, people would say, I would always not want banks in my portfolio, so I would want to have contribution to some other sectors where smart beta works in. In fact, we will not even have any biasness to any sector. There's no selection of sector itself. There is a selection of stocks based on the factor that you want to take an exposure to. So that is the main criteria to be looked after here. That is, it is auto rebalanced. It is very transparent. It is disciplined. It has a particular set of rules. These are the most prominent factors here to consider in terms of smart beta. Second is, like I explained earlier, it tries to outperform the underlying benchmark or its parent index. Parent being Nifty 500, I am taking quality, I want to beat the 500. I am taking Nifty 50, I want to take value stocks within Nifty 50, taking 20 stocks, trying to beat Nifty 50. Taking exposure to those sectors. I'm taking momentum of 50 stocks bucket, but from the 500, so that I get a mix or blend of, from the 500, like I said, large, mid, small. I want those stocks irrespective of which segment they are from, irrespective if they're large or mid or small, irrespective of which sector they belong to. I just want 50 top momentum stocks from 500. So that is how it tries to outperform its parent index, right? Third is, like I showed you, 7 factors, so you have a flexibility of going into whichever factor suits you best based on your particular interest of return, your aspiration, your risk profile. You can take multiple exposures to maybe different types of factors here, right? Also, just to highlight, one more thing is, for example, which I missed out to talk about earlier, those factors that I spoke about, right? I just go back to the slide. These, there can be single factor or multi-factor index. Okay, there are a few funds which would focus only on single factor, like an alpha or momentum or a value or equal weight, right? And there are certain funds available today which are a combination of these factors. Maybe a quality momentum. So from 500, one is choosing stocks which are high quality while having good momentum. So I combine those 2 factors, and I will have a different kind of a portfolio altogether, which will have dynamics which are different from only momentum, only quality. There'll be a fund which is focusing on alpha and low vol. So I want stocks which are doing well during certain phases of the market, during a bull run, while they are having some cushion during the downfalls, etc. So they are multi-factor funds, so they are called two-factor. They will have 2 or more factors to it. So there can be a multiple combinations available. In fact, in terms of index, there are 2 factor, 3 factor, multiple index available. You can go through it on the exchange site, right? So that is the beauty. You can again, the second point is on this is, like I said, different examples. Like I spoke about Nifty 50 value 20. I spoke about 200 quality. Spoke about 500 equal weight. I spoke about 500 momentum. So one might be confused, thinking, why is he talking about different numbers, right? So what are these numbers? These are basically segment universe. When you're saying Nifty 100, it is large cap. I'm showing mid cap 150, it is mid cap, small cap 250, small cap. Now I can take any factor and place it in any of the segment baskets, and I will have a completely different flavor. What I mean to say is, when I'm taking, say, momentum, and I'm taking it on Nifty 100, I'll just be within the large cap, and we all understand during very long runs of 3 or 5 years, a smaller mid cap would do better than a large cap, right? In general tendencies. So I'm still stuck with momentum in a large cap. While I go expand my universe and say I want momentum in mid cap, so I'm just stucking to mid cap, right? And again, there I'm saying momentum in small cap. Or for example, value, I'm taking value from 500. So those 50 might have a mix of everything, right? You might have a large, mid, small. Similarly, momentum, when momentum 500, I get a mix of top 50 from any of the segments, large, mid, small, irrespective. But I take momentum from 100, it is specific to large cap, and I'm taking momentum 200 is 100 plus 100 is momentum, large mid. Similarly, if I take alpha low wall, the universe is top 300. So within top 300, I want stocks which are mix of alpha and low wall, so on and so forth. So there is a plethora of options available, to the individual, and he can choose wisely and take his own decision in what suits his individual need, his individual aspirations, his individual risk, right? It can go from segment to segment, various factors. There's a multiple combinations that are available. So there is a lot of flexibility available. One can play with it. The next point I'm coming to is core portfolio and the satellite portfolio. What does that mean? So in general, smart beta funds, like I said, they work. They have different flavors to it. They are different factors, work differently in different times of the market. They have their own ups and downs in different cyclical market. So one cannot say that one fund per se will do well in all situations. Right? There'll be no fund, even if it is passive or active. The market itself, the equity market itself, will have its own cycles. Similarly, uh, other asset classes like gold, silver has its own cycles, fixed income has its own cycles. Similarly, these factors will have its own cycles. Right? So one has to choose wisely which factor one wants to choose from. Now, what one can do is one can always keep a core portfolio, which might be a general portfolio of market cap weighted funds, like I spoke about in my first session of passive funds. One can keep it as Nifty 50, Nifty 500 as the core, and have these smart beta funds used as a satellite. Imagine it as like a sun and the planets around it. So your sun becomes your core portfolio. You can think of what you want to do with that core portfolio. You might be having a fixed income portfolio. If you're conservative, you can have it. If you're equity oriented, you want it equity but only large cap, you can have it Nifty 50. You want only equity, market cap weighted, you can have Nifty 500 as your core portfolio, anything. And then you want to have some flavor of alpha, some flavor which is moving a bit differently, doing something else, doing something extra, that extra bit, 10, 15, 20%, whatever your comfort zone is. There you can place these smart beta funds in a mix of things and create a good portfolio for yourself. So you can play around with this specific smart beta funds. That's why they benefit you and should be part of your portfolio. Now coming to SIP, so SIPs are available only for in terms of index fund. If you are choosing an index fund from Smart Beta, or in fact any other passive fund, SIP as an investment tool is available with most MCs for these index funds. Like I again said earlier, it is a low cost. So as per mandate from SEBI, or any passive fund, including Smart Beta funds, has a maximum TR of 1% or so. Vis-a-vis, active fund might go to 2.2, 2.5%. Not putting any fund per se, but these are low cost compared to any active fund, right? So these are the main benefits of getting into these kinds of fund, right? So moving ahead, let's talk about landscape. Now we want to see how have they been across globe and across in India. So as you can see, the net assets right from 2013 to 2023, these have been very popular globally, though it's a recent phenomenon of last 2-3 years in India. But globally, these have been since long back, since a decade. They have had a 5x growth in past decade. They represent almost 20 to 25% of overall asset. In global ETFs. So it is a huge thing. If you see on the in the box in the right hand side, they have shown a split by factor. So the first top red one is the dividend. That is the flow of it that has been maximum globally, while momentum at the bottom down. So this meant to do something very different. Like in global standards, we are still a developing market and evolving market globally. Developed markets have more depth in the market. They are more matured that way. We all know that beating an index fund or a passively managed fund is very difficult. Beating a benchmark is very difficult. So in a way, it might be difficult to have greater momentum there. In fact, dividend per se, there are lower interest rates outside. So multiple factors contribute to this. If we see in India, things may be different, right? We'll come to that. So just to showcase how the landscape has been in India, like I said earlier, since COVID 2020, it has seen a 200 multiple of growth in India. It has gone from 188 crores in March 2020 to 38,000 crores in 2025. It's a huge number, and it has in fact gained a lot of traction and become very popular. That is the reason why here we are today listening to this, webinar. And thank you all for joining in. Um, so in terms of net sales, so these are flows which keep coming for different categories of index funds. So what we are trying to show here is, if you see 2023-24, and if you see YTD till Jan 25, and we are still a month away from closing the year. Uh, if you see the top, the first item is smart beta or strategy funds, right? It has gone almost three times the flows have come in smart beta funds from last year, and we are still 1 month to go down. So that is the amount of money that has flowed into smart beta funds. The next best is Nifty 50, and so on and so forth. So these funds have become very popular. This itself, the numbers speak for itself and show that this category is getting good inflows. People are understanding it. People are trying to experiment with it. Taking a lot of interest in these kinds of funds. Overall, like I said, there are 8 to 9 different types of factors. So to see how much AUM is tracking these funds, overall it is, like I said, 38,000 crores. The top being Momentum. Momentum has gained a good amount of traction, collecting around 13,000 crores across ETF and index fund. Right. In fact, next best is Equal Weight. Then comes Low Vol, and so on and so forth. There are almost 84 such schemes available in market today, tracking different funds. In fact, like I was speaking about multi-factor, there are two multi-factor funds available in the market. Alpha+Low Vol, one of them is provided by us, Nippon itself, and the other one is Momentum Plus Quality. Now let's talk about performance. So busy graph. So what we have done here is we have tried to take whatever broadest available index was in each of the factor category, and try to map the indices for a period of performance of last 20-year period. So most of these indices, in fact, all of these indices have a track record since April 2005. And what we have done is we have plotted it against each other to see what is happening where. So the red line that we see here, 60x, is basically Nifty 500 Momentum 50. Without taking into all these, the bottom yellow and the blue line, which is 15x, 15x, is Nifty 50 and Nifty 500. What we are trying to come up here is all factor indexes across a longer period of time has beaten Nifty 50 and Nifty 500 as the chart shows, right? That is what the point is about this particular chart. There may be different factors going through different cycles and with higher or lower drawdowns, but in a very long period of time, all the strategy funds have outperformed Nifty 50 and the Nifty 500, which is a broad market index, right? Now we want to dig into looking at how these funds have performed on basis of rolling returns. Just to briefly explain what a rolling return is, basically, let's say I am taking a historical data of last 20 years, approximately April 2005 till Jan 2025. We have tried to compare these indices here. So when you say 1 year rolling period, meaning the first data point will come from 1st April 2005 till the 31st March 2006. The second data point would be 2nd of April 2005 till 1st of April 2006, and so on and so forth. So daily basis will take a CAGR of 1 year, right? And it is rolled down across this 20-year horizon. So it will be more than 4,000 data points, in which then you will not have to worry about an entry or exit period between these 20 years. And average, this is again average rolling data point, not the max, not the min, the average rolling return that these funds have given, right? We have plotted this for 1 year, 3 years, 5 year, 10-year period. Like I gave you an example of 1 year. In a 10 year, what will happen is 1st April 2005 till 31st March 2015, 2nd April 2005 till 1st April 2016, 15. So and so forth. So with the graph and the heat map, you can easily see and make out that most of the smart beta funds have outperformed Nifty 50 and Nifty 500 across periods, right? Now momentum being at 28% returns in 1 year period, 20% 3 year, 5 year, and so on and so forth. If you go down, we see there's alpha low vol, we see value, we see quality, equal weight. All these have outperformed the Nifty 500 and Nifty 50 across period, right? This is point-to-point returns annualized, basically compounded annual growth rate. Um, so 1 year period, this will be point-to-point returns annualized. So here we see that the picture is changed, right? Why I say that? So your momentum find at the top, right? Low volatility was going towards the bottom. Here, low volatility shows at the top and momentum goes to the bottom. Now you will be wondering why is this happening? So this takes only point-to-point returns. So in past 1 year, recently market has seen a lot of turbulence, a lot of volatility. Um, some funds here and there, because overall market has not performed great, has had good drawdowns. Basis that momentum has taken a fall. Low volatility during tumultuous times or during market volatilities tend to do better than momentum funds. Momentum funds generally tend to do better in times of or we can say bull phases of the market, when there's a good strong uptrend, when the economy is doing great. Low volatility juxtaposition would do better during market falls. These are two extremes of alpha. Low vol would have a mix of both. If you see alpha, again, is very close to momentum near the bottom, low vol being at the top. If you see from fourth from the bottom, alpha low vol becomes somewhere in between. You know, quality low vol tend to do better in terms of market drawdowns, right? So this is talking about 1 year. If you go longer phases, right? Again, let's say 5 year period or a 10 year period. Again, you will see the green here is the higher returns in momentum and alpha, while low volatility has lower returns. But even here, let's say 5 year, everything mostly has outperformed Nifty 50, the benchmark index, right? So again, it can be seen that in longer durations, smart beta funds tend to outperform, or smart beta indices tend to outperform the benchmark indices. So this is not a snake and ladder puzzle here. Uh, it is more, we are trying to show what each factor does and how it has performed in each calendar period. This seems like a very, very busy chart. What we are trying to draw here is that each factor has worked differently in different phases of the market, right? Nothing, nor smart beta, nor another any other fund would be working always on the top or top chart in all phases of the market or across years consistently, is what the point we are making here. You can see 2005 as a column, momentum has done at the top and value was at the bottom. You start moving towards 2000, post 2008 crisis of financial crisis, and you see value being at the top, momentum being at the bottom, because momentum had just come out. The post 2008, when the recovery started, recovery might have started towards tending towards stocks which are value stocks. People would not have expected so much drawdowns in your momentum, and those stocks must have gone down, right? Similarly, you go ahead towards period, let's say recent period of COVID 2020, right? That time, if you see just after the recovery, momentum shot up in 2021. Stocks took up a bull run, right? While low volatility did not do great, it was down. Just a year prior to it, low volatility was the fourth performing. When quality was one of in the top three in 2020, when market was in a bearish phase. So different factors working different points in time. One has to be careful in understanding what factors they need to choose basis their risk profile, their understanding of these particular factors in detail. Just going by they are smart beta does not mean they are smart in terms of outperforming market in all periods in time. One has to pick and choose. Here, your strategy of having a core portfolio, it's surrounded by few factors which align to your investment ideas and your risk profile is best, right? So this is what the chart is saying. So this is plotting again of since 2005 till Jan 2025, the drawdowns that we see. So momentum and alpha, which were very bullish, work very well in bullish phases, has seen good drawdowns in 2008 periods, in 2020 periods, right? While, as the name suggests, true to its label, low volatility type of funds might have done better in these drawdowns. As you can see, during 2008, low volatility was one which has fallen the lowest. Similarly, in 2020 COVID era, also during turbulent times, low volatility had the lowest drawdown. So what we are trying to say here is one should not blindly go only by looking at a graph here which says momentum gives you 60x returns. Yes, in longer period it has given great returns, right? But one has to also realize that as you take an aggressive call towards momentum, there are also drawdowns available. Similarly, a low volatility might secure. You might feel that I would want to be cautious, but then you will lose out on the bull run phases. So one has to pick and choose according to their profiles. So again, just to give a snippet, we have already spoken about this. Passive funds or smart beta funds within that space are rule-based, auto rebalanced at fixed time intervals. Just to briefly expand that in between. When I say auto rebalanced, so what an index provider does is, like I said, they are periodic fixed intervals, quarterly or semi-annually. These indices will take a churn. What will happen here is, let's say momentum, for example, there's a rebalance that will only be done in June and December. Or say, let's say value, for example, or quality, for example, it is rebalanced only once in a year, that is December. Between that period, other than corporate actions, the stocks will not move in and out. So during also equal weight, like the weight has 0.2% weight, right? So between two phases of rebalancing, the weights may move according to price movement, and again it is auto reset to zero point 0.2 across the portfolio. So what happens here is, first advantage is that there is no call. In momentum per se, stocks which are run up in 6 and 12 months, on the time of rebalance they will be shortlisted, will form a bucket. Next review after the 6 month, when it happens again, it will look at 6 and 12 months portfolio, or 6 and 12 months returns of individual securities in the portfolio. What has run, which has been good based on certain criteria, will continue to form part of the index. Stocks who have not done well will be moved out, thrown away, excluded from that index. Stocks which have done better and were not part of the first earlier portfolio will start forming part of the portfolio. So all this exercise is very, very rule based. It is like an algo. It is auto rebalanced. The weights are assigned based on your factor, in terms of equal weight, like I was speaking. Zero point 0.2 weightage is given on a quarterly basis, between which it can go up and down. At the quarter, everything is reset to 0.2. In a way, what it does, it is doing, in a way, a profit booking for you. So for example, in a bullish phase, a zero point 0.2 has gone up to 0.2.5, 0.3, 0.4. Everything has gone up, correct? Right? It does not give you the money back, it is reinvest. It is just auto rebalancing all the securities in the Nifty 500 equal weight into zero point 0.2 again, and resetting it up. So that gives a complete advantage of, in a way, of profit booking kind of a scenario for the equal weight index. So these are very transparent rules which can be found on NSEs or BSEs respective websites for the indices. One can go through them, right? Like again, just to reiterate, there are variety of choices across different market caps, across so many strategies, in combination of single factor, multiple factor, two or more factors. One can pick and choose, create their own very comprehensive portfolio around it. These are cost efficient, low cost products, right? Which are much the cost is lower. One can take an exposure to one single unit and get exposure to multiple stocks. So there comes some efficiency. Instead of buying multiple stocks, going ahead and going on a shopping spree of different stocks, one can just buy single unit. If you believe in a particular strategy, if you believe in value, just go and buy a value portfolio, or a fund based on that index. You'll be exposed to that. If you believe in momentum, you go and buy that. So it helps you to not judge, guess, or choose, think or fear of, which stock should I pick or not pick. You just go and buy the entire basket at a lower cost. Popularity, yes, of course, like I showed you in the landscape, it has got great traction. People are seeing interest based on their own profiles. They are going and investing in that, right? Non-demand holders can go and invest in index funds or FOFs, which you give you an exposure to these kind of factors. And of course, SIP is available for index funds and FOF both, right? Coming to NAM India, Nippon India offers almost six products in smart beta category. As you can see here, first product is Alpha Low Vol, which I explained, a combination of two factors, alpha and low vol. It takes from a universe of 300 stocks, picks up 30 stocks based on both the factors. So 300 stocks will be analyzed basis alpha, will be analyzed basis low vol. 50-50% weightage or weighted average will be given to both the scores of alpha and low vol, and top 30 will be picked up. For a Nifty 50 value 20, again 50 stocks, top 20 value stocks based on P, PB, ROC, dividend yield, these scores, within the weighted average, those 20 stocks will be picked up. 500 momentum 50, again, where basket of 500 stocks which have done well in 6 and 12 months during a particular rebalancing period will be selected. In equal weight, like I said, 0.2% weight across all 500 constituents, right? So these are for index funds. In ETF format, we have the Nifty 50 value 20 again, and the dividend opportunities 50, which picks up stocks which are higher dividend yield. So these are the six products that Nippon offers on different factors, right? So you can go and explore those or others in the industry. There are plethora of schemes available right now, across schemes, right? Yeah, and Nippon, like I said earlier, we have a good track record of more than 24 years managing ETFs and index funds. Or passive suite has almost 24 ETFs, 24 index funds across equity, commodity, debt. As of now, we have gold and silver as the main commodity in our portfolio, right? So that's all from my side. Again, we this is not an investment advice, or we are an AMC. We provide a bouquet of products to their customers, to the investors, for them to think, choose it wisely, or take an formal advice from their advisory for what kind of fund suit them according to the risk and return profile, right? So please go ahead, explore yourself. And being an AMC, I need to say mutual fund investment are subject to market risk. Do read all of our documents carefully before investing. I hope you enjoyed this session, and thank you. I may take questions whichever you may have.
No, this webinar was truly insightful. I'm sure we've all learned something about the smart beta funds, momentum, alpha, and low volatility funds as well, and how it can be beneficial. Before we conclude, I'd like to open the floor for any questions from the audience, and we'd like to take them up and answer them.
Sure.
We have a question from Harish. Can smart beta be compared to Nifty Next 50?
Sure, Harish. So smart beta funds are based on different kinds of markets, right? So Nifty Next 50, when I come to say that, is basically part of Next 50. The name itself says so. Nifty 50 as part of the large cap universe from the Nifty 100. Those stocks which are not part of the Nifty 50 universe come within that 100 in Nifty Next 50. So it is basically a large cap scheme, right? So whenever you are comparing a smart beta, you have to be mindful that which factor and which smart beta you are talking about. So for example, ideally, if you are taking any smart beta fund, which is from the universe of Nifty 100, which is based on maybe Nifty Next 50 or Nifty 50, that might be comparable. But otherwise, if you start taking, for example, let's say momentum from a mid cap space, like a mid cap momentum 150 mid cap, that may not be comparable. So one has to look at what universe are you looking at, which factor are you looking at, and then which is the universe against which you are comparing. So ideally, for comparison purposes, it is easier that you take the parent of the index itself. For example, just to name, a fund says, for example, Nifty, 500 value 50. So you have to see that value 50, right? It has taken from the bucket of 500, it has taken 50 stocks. So ideally, it will be good to compare it against Nifty 500 itself. If you are taking Nifty 50 value 20, right, from the large cap bucket, so it is ideal that you compare the value 20 taken from Nifty 50, so you compare it against Nifty 50, right? Similarly, you take a quality 230, so your benchmark should be 200, right? Quality 200 index benchmark, and against which you will compare your 200 quality 30. So ideally, generally, these funds or indices will have a parent name generally involved. So one has to look at that, and it will give a better picture of comparison. I hope that answers your question.
We have another question from Radha. How is Nippon India ETF best to invest?
So I think it is saying how is Nippon India ETF 50 Bs to invest. So hi Radhika. So Nifty 50 ETF basically invest in constituents of the underlying index, that is the Nifty 50. It will invest in all those stocks which form part of the index, right, in the same proportion of the index, uh, x of expense ratios, right. So it will try to replicate whatever returns are given by the Nifty 50 benchmark itself, right. So that is how it will work. You may take, if you are looking to invest in a scheme which is a large cap or a Nifty 50 or a fund which is a Nifty 50 based fund, you may choose to invest in such ETF.
I would like to repeat that if the audience has any questions before we could conclude, we're opening to answering them as well. We have a question from Siddharth Malik. How smart beta is different from focused fund schemes?
Okay. So, hi Siddharth. So, see, focus fund schemes. So, I'm not an expert on the active side of schemes. So, focus fund schemes are more to do with maybe focusing on particular theme or maybe a particular small basket of stocks based on an active fund manager's choice. Right? Those stocks will be selected. This is their expertise and judgment of how they want to stick. Mostly these focus fund schemes will have a smaller basket of stocks, right? As the name suggests, they will have a focused exposure. Smart beta per se, like I explained, has different kinds of exposures, right? It will not be very right to compare these two funds together, right? Smart beta will give you an exposure or a selective exposure to the type of product you want to take an exposure to. A momentum will give you an exposure to stocks which are momentum based. Value based product or smart beta product will give you exposure to value based stocks. So that is the ideology of that particular factor which you are trying to select, and accordingly it should work out, right? So again, these will not be very truly comparable products. So when you are taking a smart beta fund, you have to see which factor are you picking, what is the nature of that factor, or how it is going to work out. Whether you are looking to invest in value, whether you're looking to quality, whether you want a diversified exposure into equal weight, or whether you are trying to do a momentum, right? So you are taking a active call in that. For multi-factor fund like an Alpha+Low, while you are taking a call into that. So it may work very differently and would not be right comparison against each other. If that helps answer your question.
We have one question. I think this should be the last one. one from Prabhas Trivedi. In this market condition, which beta factor is likely to outperform?
I expected someone asking this. So, very difficult to tell, a very difficult question to answer, to be very honest. One would never know which factors work when. But looking at, past historical insights, and again, past returns cannot guarantee a future, pattern or change. It is a difficult question to answer in terms of what should work when, right? Generally, like when I was talking about in the presentation, certain factors would work in certain periods of time. It may or may not work in certain phases of the market. It may work well attuned towards certain phases, like for a bull phases of a market when markets are doing very great. If you're already invested during those runs, a fund like Alpha or Momentum might do pretty well for you. While during down phases of the market, a fund like a low volatility exposure quality might do well for you. If you want to take a balance call, Alpha Low will do well for you. If you want to take something like a very long term view and say, okay, irrespective of how the market moves, I want to take a call for 10-year period or 5-year period. I want to have an exposure to all stocks, but still very diversified. I'm okay to take large or mid cap and small cap as a higher exposure, because they tend to do perform well in long periods such as 10 years, and equal weight might do well for you. So it completely depends on your time horizon in which you want to invest, what is your goal of investment, and what is your aspiration of theirs. So there are multiple factors that are involved, so one needs to be cautious of that.
Thank you, sir, for your insights on the fund. And we surely found this session insightful. And I hope the audience liked it as much as we did here. Your expertise and passion for the subject were evident throughout your talk. We appreciate you taking the time to share your valuable insights with our audience. Thank you very much.
Thank you, Angelica, and thank you to the viewers for taking your time out for this webinar on behalf of SPI and Nippon. Thank you so much.
Thank you.